We are live. I'm your host, Jake Fox, and this is another edition of Black Tower Radio. We are broadcasting live on 1040 AM, 92.1 FM, WYSL in Rochester, New York. Also on World News Radio .today. That's World News Radio .today. And we are joined here today by author, columnist, investor, Mitch Feierstein. Mitch Feierstein is a British-American investor, banker, and writer. He has worked as a columnist for the Daily Mail and currently works as a columnist for the Independent and the Huffington Post. Feierstein appears regularly as a financial commentator on Sky, BBC, and RT's Kaiser Report. In 2012, he published his first book, Planet Ponzi, which gives his perspective of the global credit crisis. Welcome back to the show, Mitch.
Thanks for having me here today, Jake. I'm glad that I could be with you and try to chat about Yellen, the Fed, and why you can never taper a Ponzi scheme.
That's what we wanted to get into. Today, Yellen decided to raise rates a quarter of a point. What does this all mean?
Well, there's a couple important takeaways. Bubbles, asset bubbles, stock bubbles, every kind of bubble you can imagine, and Ponzi schemes both have similar baseline characteristics. They both end very badly. Now, the Fed raising rates, they've been jawboning about raising rates for the past 3 or 4 years. It's actually been, 9 years? I think 2006 is the last time there was a rate increase, and we've gone straight down to zero. And what that has accomplished is the Fed has enabled cheap money to allow companies to borrow and buy back their own shares in the form of buybacks, share buybacks, issuing massive amounts of debt. If you take, for example, earnings were just announced by Oracle, and it said that they topped their earnings per share estimates, but revenues fell. And that's the story across Wall Street. So we're in a revenue recession with a lot of these companies, which is masked by the Fed's wild money printing and making money available to companies. So, as I would say, the largest debt sales in corporate America, take, for example, 2014 in billions of dollars, a company like Oracle issued $10 billion in debt. In 2015, they issued, I think in April, they issued $10 billion worth of debt to pay dividends and buy back their own shares. So obviously, the more shares you buy back, the higher the price goes. Less shares, higher earnings per share. But the revenues keep declining. That's the actual money that the companies make. So we're seeing a rally in the stock market. We're seeing that the Fed's cheap money that they provided has caused a revenue recession and really hurt Main Street. It's hurt everyday Americans. It's taken about, with interest rates coming down from the highs in 1981, I think the 10-year bond was trading above 15%, and it's come down to basically 2.02%, with the low being 1.38. What that has done to savers, it's devastated savers. The recent cuts and the ZIRP, zero interest rate policy that this Fed has implemented, has cost savers probably $800 billion. So they've killed savers and killed students, and they've helped Wall Street. And it hasn't. The theory is to increase aggregate demand and make the economy tick over, which it hasn't done. It's been an abject failure. And instead of changing the policy and rethinking it, all that they've done is added to a losing position. So in the scheme of things, raising a quarter of a point when interest rates were up at 15% from zero, this is really meaningless.
And manufacturers would never get this sort of a rate if they went to borrow money. I mean, seems everything that the Fed does is pointed towards banks. It's pointed towards Wall Street, and like you said, Main Street gets nothing but the shaft. Savers get nothing. Manufacturers get nothing. I mean, it's just everything's being torn apart for the sake of the markets.
Well, that's exactly right, and you just keyed in on one of the biggest factors and problems. That if you go and you look over the past eight years or 9 years at the rigged unemployment statistics, if you look at manufacturing jobs, there's been a contraction in manufacturing jobs. There's been no growth, or actually negative growth, in manufacturing jobs. The jobs that have been created with these ridiculous Bureau of Labor Statistics numbers have been low pay, part-time. We should have a bartender and waiter index, because that's reaching an all-time high, as well as employment for those who are 55 or older now, because the retirees can't afford to retire, because they used to be able to buy a CD that would pay them 5 or 6%. Now they don't get paid anything. And as I was telling somebody today, that's just the beginning, because the Fed, this vicious cycle that they've got going right now, their jingle for Christmas is, you better watch out, you better not shout, you better not pout, because negative interest rates are coming to town. That's their theme.
So, I mean, you wrote the book Planet Ponzi, and it makes me think, every Ponzi scheme has its moment when it blows up, like Bernie Madoff's came to bite him in the butt. I mean, when do you think, or what do you think will bring that moment upon us?
Well, I've done a bunch of interviews starting last year, I guess Q3 of last year, and I highlighted to a lot of people the big disconnect between high yield, what you'd consider junk bonds, the actual issuance of junk bond debt, and the junk bond equities. And what the Fed, their interest rate policy, has done has enabled zombie companies, or companies that should not be able to purchase, get cheap funding, to get lots of cheap funding. So I think, it's been prolonged now for probably over 13 or 14 months that we haven't seen an implosion. But we've seen 3 credit funds blow up in the last 2 months. And I think, that is a signal that people just want to disregard. My book, the premise of my book, Planet Ponzi, it's the best descriptor for what global governments, the European Central Bank, the Federal Reserve in the United States, the Bank of Japan, and the Bank of England are doing with debt. It's too much debt, too much credit, and too much leverage caused the original crisis. Now, what have we done? What lessons have been learned since then, and what have we done? Okay, so we've done pretty much nothing. We've learned no lessons, and the debt, the credit, and the leverage are a lot higher. Consumer debt has skyrocketed. Government debt has skyrocketed. Consumer debt, credit card debt, I think is over 1.2 or 1.3 trillion. Student loans are 1.2 trillion in America, and the default rate is higher than it's ever been. We're at a historic high. So you've got the younger generation of students that go to school and they pay for an education, a substantial amount of money, and when they get out, they're largely in debt, and they can only get a low-paying job, maybe $20,000, $25,000, and rents are at an all-time high, which is not part of the inflation calculation, of course, because if it were, we would have inflation is probably somewhere around 12 to 15%, because rents have gone up astronomically. Everyone who listens to this broadcast realizes how much rents and the cost of living have risen, but the government doesn't want to portray that in the statistics that they show, because it's like putting lipstick on a pig. And as much lipstick as you put on a pig, you'll never turn it into a supermodel.
Sure, and you mentioned the 2008 crisis. I mean, and that was a big tipping point for economically for America and the world. But I mean, that was the result of years of bad policy. What's the genesis of where we are now? When did that start?
Yeah, I don't know that it was years and years. I mean, I think if you go back and you look at the charts, and I go through this in detail in my book. I mean, I think that the real tipping point was when Bill Clinton, who was forced or pushed by Larry Summers and Robert Rubin. Rubin worked for Larry Summers, and Tim Geithner worked for for Larry Summers in Treasury, they pushed Bill Clinton to get rid of Glass-Steagall, and that allowed for these wild securitizations where they sliced and diced different tranches of loans. So in other words, they were selling products. Wall Street came up with these inventive, and these are back now, by the way. These same products are back, and I'll get into that in a second. But they sliced and diced up these products and put crappy subprime loans. They packaged them up and put them into bundles and sold the whole thing as a AAA credit-rated product, except it wasn't. So when the markets froze, that's when the credit incident and the blow-up happened. Now, oddly enough, one of the credit funds that blew up last Friday that caused the stock market to have a hiccup was the same guys who were running the same type of credit fund at Bear Stearns. So, who learned that? They gave them $6 billion to start up a new fund to do the same thing that they lost money on last time. The problem we have is that, we don't need new regulation. We need to have existing regulations enforced. What you have here is you have zero accountability and zero transparency. I mean, I think Jimmy Carter summarized it best in July when he said that, the United States Congress and the United States Senate has turned into a shambles. He goes, I think the exact quote was, the United States is no longer a democracy. It's turned into an oligarchy, and it's run by oligarchs. So what do we have? We have democracy that's turned into plutocracy, actually, and we're headed straight towards fascism because there is no rule of law, and we have separate rules of law. We don't enforce rules against the banks. We enforce rules against the little guys. I think that's why you're seeing such a divergence in politics today, and you're just seeing people are so disgusted with the mainstream political theme right now. They want somebody who's outside of K Street. I mean, the revolving door of Wall Street needs to be slammed shut and never opened again. And we need to have regulators with teeth. There's zero reason. If there's no penalty, there's zero reason not to keep repeating the same mistakes that we've made or the same crimes on Wall Street.
I mean, I'm hearing all of these things happen around the world, and some of them you've touched on. We have bailouts here and bail-ins in other parts of the world, and all these fraudulent financial instruments that people use in the United States and in the city of London. I mean, this isn't capitalism. We're not practicing capitalism anymore. I mean, this has been, like you said, this has been taken over by a very few. I mean, power is concentrated in the hands of very few people. This isn't a fair system anymore we're operating under.
Well, I wrote an article that summarizes this a year ago or so, and the title of it was "Capitalism Without Bankruptcy is the same as Catholicism without hell." You have a system where bankruptcy should take out the non-profitable companies. It shouldn't be the Federal Reserve coming in and giving them more money. I think what the Federal Reserve is confused about is providing excess liquidity to an insolvent is not the solution. That doesn't help anything. A liquidity provision for insolvency is not the answer. The insolvent will just lose more money. And what they don't realize is, in addition to killing savers and stealing 700 or 800 billion in savings from the savers, which is being sucked out of the economy, and putting students in debt that they can never repay, pension funds and insurance companies are the next to go bust, which you will see happening soon. I mean, the media is part of, they're complicit in the whole thing because the media doesn't want to report any of the really important financial stories today. And if somebody has a story like I have to tell, they don't want to hear it. They don't want to hear grounded reality. I mean, how much have you seen publicized about the $72 billion that Puerto Rico is defaulting on? Have you seen that everywhere? Probably not.
No.
But that blew up a lot of these credit funds because they were holding derivatives and bonds on the Puerto Rican debt. Now, nobody wants to talk about that. They just want to make believe that it's not happening. And they also want to make believe that 104 million Americans are unemployed with the way that they calculate these statistics. You know, the way that they calculate the statistics, they make up a birth-death rate for new businesses, and they just throw in a big number if they need it, you know, which is more than fantasy. So the way that the unemployment numbers are currently calculated is not fit for purpose, and that should be clear to everybody. Unemployment is not 5%. That's a fantasy number. The way that works is if you collect unemployment, I don't know how long the unemployment rolls go, but once you fall off those rolls, right, you're not unemployed anymore. You just don't exist, so you're not part of those numbers. So we have the participation rate, and the participation rate, labor participation rate, has not been this bad since Jimmy Carter was president in 1977. So I think we need to really review or reflect on what we need to do to bring an economic reality to the folks out there and stop being duplicitous about the way we report on the economy. But, unfortunately, mainstream media is controlled by 6 conglomerates. So, the narrative that they want to put across is the narrative. If you go back to share buybacks, and if you look at the companies that are making money, there are 3 companies that come to mind off the top of my head. You've got Raytheon, which is a government contractor. You've got Lockheed Martin, whose shares, since George Bush's war on terror started, are up around 1,250 or 1,300%. You've seen the massive skyrocketing in these military defense contracting shares. That is who is lobbying and running America, which is America used to be a great democracy, but unfortunately it isn't any longer, and it's controlled by a small minority of lobbyists who control the politicians in Washington, and we have to change that. And I talk about that in my book, that we need to vote these people out and change it. Congress and the Senate, their approval rating is below 10%, and there's a reason. They keep getting elected. So, I don't know how many times people need to bang their heads on the wall. The only way that you can change things is getting rid of that old guard and putting new blood in. It's actually going to change things and stop lying to us.
Well, my favorite president of all time is Teddy Roosevelt, and he was the trust buster, So isn't the onus on the president a little bit? To break up these banks and companies that have control of our economy, or would you say it's impossible? Because the president and other politicians are relying on these same companies to fund their political campaigns.
Well, I think it's kind of a catch-22, but you're going to start seeing. If you look around the world, you're going to see the global economy, I think, is in a recession right now. They can mask it for a little while, but all they're doing is slapping on some Band-Aids on like 50,000 razor cuts, and eventually the gusher of blood is going to start coming out. China is a disaster. The Baltic Dry Shipping Index is at 40-year lows right now. China's debt has gone in 7 years from $6 trillion to $32 trillion. Their economic numbers and releases are kind of a joke. There are opportunities with. I'm not negative on everything, because I think in every crisis there'll always be pockets of opportunity, and there are a lot of pockets of opportunity, but one of them is not the U.S. stock market, it's not the U.S. bond market, and it's certainly not the U.S. property market. So I think people need to be nimble, and they need to figure out how they can protect their assets to get capital returned rather than return on capital. So that is what the takeaway should be for everybody.
What's a tool that any central bank can use to restore balance to the markets? More specifically, the U.S. Federal Reserve.
I think the U.S. Federal Reserve should be shut. I think that they should audit it and close it. I think that they are operating under a mandate that was given to them in 1913, before derivative products existed and before the economies got to the side that they are. They've overstepped their boundaries. Nobody knows what they're doing. They're cloaked in secrecy. They refuse to allow an outside independent audit. We have no idea what their $5.1 trillion balance sheet consists of. I think, the Fed, the ECB, the Bank of Japan, and the Bank of England are all problematic. And I think during the next crisis, there will be legislation to change the way they operate. And I think a lot of their power needs to be taken away. It's not up to a central bank in capitalism to try to regulate prices. Price fixing didn't work in Russia. And price fixing, when Nixon tried it, price controls didn't work in 1973. Price controls don't work. All you do is create unintended consequences. And I've got news for you. The unintended consequences of the last 9 years of printing $100 trillion is going to be substantial, and it can take down the entire global financial system.
But, sorry, go ahead, Mitch.
Well, and we haven't even broached the topic of the massive currency war that we have going on right now. And, in the form of, if you look at Japanese yen over the past 18 or 24 months against the U.S. dollar has dropped about 30%, somewhere in the range of 30%, from 77.25 up to 125. That's a gigantic move. That's a currency debasement, okay? That's a devaluation. The same thing has happened with the euro. The euro has gone from, 142.10 down to 105. That's another substantial move. That's a currency devaluation. Now, Japan is a prime example. They've been doing QE for 30 years. Has it helped? No, not at all. In fact, when I argue that property prices can drop 90% in the United States and in the UK, I will cite Japan as my evidence. If you look at how much, go and do your research and have a look at how much property in central Tokyo has dropped between 1987 and 2014. I think that the most it dropped was 90%, but it hasn't returned. It hasn't returned back to a normalized price in the past 30 years or 35 years. So, can that happen elsewhere? Not only can it, it will, and it's a matter of when it will happen. And I think, the more that central banks meddle in capitalism and interfere in markets, the more unintended consequences you're going to get. Like, I think the biggest bubble to collapse next is probably London real estate and property, which I think blew up about 12 months ago, but it takes a while to show up and manifest itself in the markets. But they've got a gigantic overhang of property coming on the market. The U.S. property market will probably be short after, and Canada to follow. Canada, the U.S., and England have monstrous pockets of bubbles. I mean, New York property being one of them. And you'll hear, if you talk to the brokers, they'll tell you that the Russians are buying, the Chinese are buying. Well, I've got some bad news for you. The Russians are not buying property right now. Their currency has gone from 28 rubles to the dollar to up to close to 70. So, they've lost a lot of their wealth in the currency collapse and an economic crisis. Their stock market, however, I'm on record as saying last year that I loved their stock market because everything was undervalued. Has been the best performing stock market, I think, in the world this year. And as far as China going out and buying real estate, they're not spending money right now either. So, I don't know where the buyers are coming from. I don't think that they are out there as they were, but I think we're way overdue for a correction, and I think the liquidity that's been pumped into the markets by the central banks has only led to a more exaggerated downside when it happens. I think we'll have a crash worse than 1929.
What about the bond market? There's pretty much been a multi-decade bull market when it comes to bonds. the central bank could certainly do something about that and kind of rebalance things in that sector. I mean, there's a bond bubble that we're facing.
No, it's not a potential bond bubble. I mentioned it earlier at the beginning. It's one of the biggest bubbles that we've ever seen in history. We've gone from in September of 1981. I think we've gone from 15.3% down to 1.27% straight down. These bonds are grossly overvalued. I wouldn't touch them with a barge pole. But the problem in America, and the reason why the Fed can never really raise interest rates, is because if they raise them above 4%, then the debt service, the interest that they have to pay on the outstanding debt they have, far exceeds revenues, and that means they're insolvent. That's the problem. So in our lifetime, they can never raise rates. Now, the emerging markets, going back to the currency war scenario, are where the problems are going to kick off, because the dollar has been very, very strong for the past 2 years, which means it's gone up 30% against certain emerging markets like Brazil, Argentina, Venezuela. All of those countries, our currency has surged, and they've got massive amounts of dollar-denominated debt. So that amount of debt has gone up by 30%. So there's going to be a massive amount of credit defaults that's going to help precipitate the next credit crisis, based on malinvestment in those countries and based on Fed policy providing too much money to slosh around to try to create demand, which it didn't. All it created was malinvestment and bubbles everywhere.
So do you think Yellen made a mistake when trying to keep this bubble going, and she raises rates?
I think Yellen's made a series of mistakes. I mean, you have to remember that Yellen's been on that board for 12 years. She's been on that Federal Reserve Board for 12 years. She was Bernanke's right-hand man for years as vice chairman. So has she made mistakes? I don't believe she's ever voted no against any policy that's come up. And if you think about how she got into office, I mean, the president put her in there. She's a yes woman. She goes along with any policy. She's an academic. She has zero business experience. I think that's all part of the problem. And it's going to end badly. So I think what people need to do is protect their assets and figure out what asset classes they need to be invested in to keep their powder dry, because the overvalued ones will crash and other ones will outperform. And I still like, there are a lot of sectors that I like right now that most people are telling people to stay away from. I think you should be pretty much out of equities right now. I think equities are grossly overvalued in the U.S. I mean, I like some emerging market equities, but it's too early to get in. I really like gold where we are right now. Physical gold, not gold ETFs.
We've had some expert economic people on the show that say they like the dollar long term because of whenever there's turmoil in the world, people usually flock to the dollar, and
right.
They say the only time that hasn't happened was during the Cuban Missile Crisis. People fled the dollar during that situation. Do you like the dollar long term against all the? Okay.
Nope. I don't like the dollar long term. I like the dollar for a short term trade. I have had a position in the dollar being long. I would start to pare that down. I hate the euro. I don't think the euro will exist in 5 years, but I think that trade is one of the most crowded trades on the planet, long dollar. And I think a lot of people will be surprised when the dollar comes down. I think you can look for some surprises out of China when they devalue their currency. And I think that's going to really rumble the markets and probably cause the Fed to do QE4, QE5, and then eventually negative interest rates here. I mean, so, you've seen them raise rates, but next year is a presidential election cycle, and never in the history of presidential election cycles have rates gone up. So I just find it disingenuous that the Fed says they're going to raise rates. I think they're going to find some reason either to stall it or to do QE4, QE5, and then negative interest rates.
What do you see coming out of the BRICS? Brazil's pretty much in a depression right now.
Right.
China's not doing so hot. What do you see in the future for them?
No, they are in a depression, as I mentioned, and I think that a lot of the emerging markets, if I were to pick one of them, I probably like India best, but I think a lot of the emerging markets in Latin America have oil as a major export, and they're commodities based, and we are at probably 20-year, 17 or 18-year lows in commodity prices, and that is due to global recession and lack of demand rather than anything else. So not only do those countries survive on their oil revenue, which if you think about oil, and I've been negative, as you know, last time was on your program, I spoke about how negative I was on oil, and I was the only one who was negative on oil when it was $80 a barrel, and you had Janet Yellen saying when it was $80 a barrel that it was transitory. I said, yeah, it's transitory, all right. When it gets to 20, give me a call, and then I might have some interest in it. I'm still very negative on oil prices, but you've got to realize that a lot of these countries, so you've had a 60% or 65% down move in Brent crude. WTI has moved a little bit less, but this hurts economies in a big way. And all of these emerging economies, as I mentioned before, their debt is U.S. dollar denominated. So they've got less revenue from oil, right? Less GDP, yet their debt has gone up by the amount that since the dollar has surged too. So their revenues are down, their currency's down, yet the amount of debt has gone up by 40% or 30%. So it strangles them. They're going to all end up in depression, and eventually it's going to come full circle and hit. When they default, the corporations that have exposures there are going to have to write that stuff down.
What's behind this drastic fall in oil prices? I mean, you just touched on some things, but I mean, it's just the bottom has fell out on oil.
But no, it hasn't. It's I would disagree with the bottom has fallen out. I mean, if you go back and look for 30 years at an oil chart. I mean, I'm an old man. Not really, but I'm old. I've been around for a while. In 1999, I remember when oil was trading below $10 a barrel. It was trading at 9 and change. So you have to remember, Iran is coming back online. There's plenty of supply out there, and whenever you have a global recession, there's less purchasing of oil, right? So if you look at the numbers, I mean, there's plenty of supply and there's less demand, so the price will fall. 153.10 was the peak, and if you have some time, if you draw a graph of quantitative easing, like when the Fed did QE1, QE2, QE3, superimpose that over the oil price, and you'll see something remarkable. When they stopped their QE3, that's when oil prices started tumbling. So the QE, which I contended at the beginning of this interview, was the cause of malinvestment. And they've pumped money into shale oil, which is profitable at 85 or 95 a barrel, which is now, we're trading below $35 right now in the aftermarket. We haven't been this low in 11 years in the oil markets. So, can it go lower? I haven't changed my fundamental view, and I was probably in a minority of people who said this 14 or 15 months ago that oil was going much lower. I haven't changed my view. So, I think that will end up in a lot of defaults in that sector because there's probably $1 trillion in derivative product and loans in the shale oil patch. Even though a lot of the talking heads on mainstream media will tell you to buy the dip in that, I wouldn't touch it.
Yeah, the fracking bubble in the United States is going to pop, and it's going to hurt a lot of people. Everything I've read about that is a looming disaster.
Well, that's all. It's already popped. I mean, I told you the break even on some of those projects is $80 a barrel or $90 a barrel. So it's the same argument that you get when people say don't buy gold. It's going to 300 or 400 an ounce, and my response to that is, okay, so you show me one of these producers, because the average cost, if you look at the average cost for them to pull an ounce out of the ground and refine it, is a little over $1,000 if you take all the production. So who's going to produce a product, anything, that costs $1,000 and sell it for $300? You can create these fake paper markets that the government's using to manipulate metals prices, and they're allowing rampant manipulation. But eventually, somebody who's smart is going to come in and buy those contracts and say, I want physically delivered product. And then you'll have an exchange failure, or they'll just change the rules and say, oh, these contracts are zero, they're not backed by anything, and the exchange has failed, sorry. So, eventually when reality comes to roost, gold will be much higher, because at the end of the day, gold for 6,000 years has been a currency. Paper is backed by nothing. A promise to repay the debt.
How long can Yellen and her counterparts keep this game going?
Well, that's difficult to say. I mean, I'm kind of surprised it's lasted this long, but I think the markets are losing confidence in the central bank's ability to do as they've represented on the bottle. So, I think at any point in time, I don't see these markets going higher. I think 2016 is going to be the year that we have a crisis before the presidential election. But obviously, the Fed is going to want to try to manipulate good times going right into the election, because President Obama appointed Janet Yellen to keep things calm through the next election cycle. So we'll see what happens. I mean, it'll be interesting, but I don't think they'll be able to hold these markets together much longer, because I'm seeing too much stress in high yield and too much stress in other markets. So I think that it's really going to be a problem. I mean, they can manipulate the stock market by providing liquidity for CEOs to pay themselves big pay packets by buying their own shares back. But eventually that's going to end. And it's not going to end well. It's going to end very, very badly.
Do you see this being like a 2008 style financial crisis? It doesn't seem like they have enough ammunition like they did in 2008 to really stave off a huge disaster.
No, I think it'll be probably the worst financial crisis that the world has ever seen. I think it'll be much worse than 2008 when it happens. But it will be a slow grind. It won't happen at once, and you're going to see some big failures, and you'll probably see some sovereign defaults of bonds in Europe.
So it's not going to all melt down like a 1929 style situation. It'll be, over like a couple of year period, you're saying?
No, I don't think a couple of years. I mean, I think it'll happen in a couple of months. I think it'll be pretty quick once it starts deteriorating. But, it won't happen overnight. But that's why, I think now is the time to plan your exit strategy to make sure you're not slammed by it and caught wrong-footed.
So what do you see economically in the next 3 years for the world, global markets?
Well, I mean, look, you've got to look at global GDP. Global GDP has been going down steadily, despite the IMF and the World Bank and the BIS forecasts. They've been dreadfully wrong, just as Janet Yellen and the Fed have been dreadfully wrong. And instead of changing their policies to try to adapt to something different, they just keep adding to losing positions, which you should never do. The world economy is going to be problematic because all of these, emerging markets are going to default on their dollar-denominated debt. High-yield markets are going to be a big problem because there's too much debt that was given out, between 5 and 10%, that should never have been. I mean, you've got valuations like Uber is valued at $60 billion. Anybody who buys that stock at a $60 billion valuation deserves to lose everything that they put into it. It's like that company GoPro that went from $100 a share down to, where is it, 9? It could be the next Kodak and go to 0. I mean, there are so many companies. This is a NASDAQ bubble 2.0 on steroids that are way overvalued that shouldn't be there because you've got people chasing momentum. You have to remember that most of the traders who are involved in the markets today haven't been in the markets to ever see interest rates go higher, so they don't think they can, and they haven't seen, a real correction, a meaningful correction in stocks, because since the credit crisis, stocks have just gone straight up, 300% or whatever. from where we have 667 in the S&P up to where we are today, up to over 2,000, right?
Yeah, I mean, do you think this is going to blindside the people at the Fed and people in central banks around the world, or do you think people are fully expecting this? Because it almost seems like these are steered into election years in the United States. 2008, 2000, 2001. These were all put in right when we were about to transition to a new president, or shortly thereafter, anyway.
Well, I don't know how they could not see the reality of what's going on in the markets. But I guess, that's the problem when you get people like Ben Bernanke, who his life career was MIT and Princeton, and he's an academic that's
Sure.
never had a real job in his life. And now when he gets out, he's got, $1 million plus pay packet from PIMCO and Citadel and all the other hedge funds that bring him in, and Goldman, who pays to have him, pays him $350,000 for dinner. So I mean, what's the disincentive for them not to keep easy money when they know that they're going to be rewarded by the financial institutions? You've got perverse incentives, so of course they're going to toe the line. It goes back to the whole thing. How the United States has morphed into an oligarchy. Eventually it's going to end fairly badly.
Mitch Feierstein, planetponzi.com. Go to planetponzi.com. Check out all of Mitch's writings and all of his updates and everything on there. Also check him out on Twitter at planetponzi. Mitch, you have the floor. Talk about anything you want in closing.
Yeah, I mean, I just think people should realize that there's a ton of asset bubbles out there, and it's all due to central money printing and central planning. In capitalism, we have a very important mechanism called bankruptcy, which is what I think we need to do, is let companies go bankrupt and not keep bailing them out. If you do keep bailing them out, what we're going to do is have one day one of the biggest global financial crises that the world's ever seen. And so to do that, we need to vote people out of office and put people in who have a business sense, that have not been part of the old political crony capitalist system.
If you're right,
thanks a lot. Thanks a lot for having me on.
Well, if you're right about a 2016 financial collapse, the world has never seen, I think the political solution you're talking about will happen from angry mobs tearing them out of their offices and replacing them with much more capable and moral people. So, unfortunately,
well, let's hope it doesn't degenerate that quickly. But I think unfortunately we're headed for a rough time.
Well, thank you very much, Mitch, and hope to have you back on again in the future.
Great, thanks. Have a great holiday.
You too.
Bye-bye.
And that was Mitch Feierstein, author of planetponzi.com. Up next, we will be joined by Wayne Madsen with our weekly segment, The Week with Wayne, where we run down all of Wayne's articles as he's written in the past week, and we detail them here on the show on Black Tower Radio, broadcasting on worldnewsradio.today every Wednesday, 5 to 7 p.m. Eastern Time, U.S. So stay tuned. We will be right back with Wayne Madsen.